Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's the Wednesday morning and it's getting very, very dizzy. If you're trying to follow those tariff headlines, well, good luck. Well, that's what we've been doing here. We'll talk about it. I'm Surabhi Upadhyay. As always, with me is Nigel D'Souza. We have Rima with us. Guys, it's just too much news. I must admit, I'm a news junkie, a journalist at heart. But even for me, too much news for these markets.
Oh, indeed. It's 25%. Is it 50%? Is it on pause? Is it a 1 month? It's just dizzying, the kind of news flow that we've got over the last, month and a half since he's been in office. But it's just getting amplified, I feel.
Well, in the last few days, the feeling you're getting is, thank God you're in the Indian markets. Because you have a couple of global triggers that are working in your favor. You have policy that's supporting both from the RBI as well as the central government as well. So the Indian markets in a very wobbly environment seems like a good place to be in.
Yesterday's price action was very encouraging.
Very encouraging.
Closing at the day's high near to 22,500 in the face of the global.
But then that FPI sell number, it started inching higher. So, it's a fairly muddled situation that we're in the midst of, but I completely take that point that even if you exclude all the tariff headlines, we are a domestic-facing economy at the end of the day. Yes, exports are extremely important, more services than goods, but we have a lot going domestically for us as well, and maybe that's exactly what the bulls will eventually focus on.
And yesterday, Rhythm sounded very, very confident that the domestic flows will continue. Today, we'll be hearing about the past month's
mutual fund
flows.
Data.
So that's going to be the big trigger to track. Retail is hanging on, holding in there, showing the big money. That's going to be important. Okay,
so let's straight away get to it. In terms of retail flows, hopefully we have absolutely no problems. We haven't had any for the past 6 months or so. But globally, those headlines, as we've been telling you, are, they just sends your mind in a tailspin. Because, just see what happened overnight. Very volatile session on Wall Street and indices sort of following different colors. What happened was there was this headline around 11:30, 12 o'clock our time that now instead of 25%, Trump has threatened Canada with 50% tariffs on steel and aluminum. And why is that? Because Canada said that we will be putting an additional tariff or a surcharge of 25% on the electricity exports going into the US. So there was this absolute trade war skirmish that was playing out. By the time we woke up, thankfully, it had been rolled back, and that's largely because Canada kind of dialed back on its position. You had the Ontario Premier, Doug Ford, saying that we will pause those additional 25% tariffs on electricity, which is, going in from Canada to the US. In response, President Trump also pressed the pause button, and he said that no, as of now, it'll be the original plan, which is 25% tariffs on steel and aluminum. So that's what happened. It did whipsaw the markets all over the place. The S&P actually intraday slipped into that technical correction territory, which is 10% fall from the peak, then kind of recovered a little bit, still ended with a cut of about 0.7%. Dow was down 1%. NASDAQ relatively better off because there was some buying, some bargain hunting going on in tech stocks, which are beaten down quite a bit. Yesterday, airline stocks are very weak. Some of the carriers in the US are coming out with a bleak outlook, cutting back their earnings expectations. So travel stocks, airline, travel, hospitality, stocks like Airbnb, they were down 4-5%. So that's where the hit was yesterday. Now, what has, Donald Trump said? For me, among all the commentary coming in yesterday, this one quote on the stock market was very, very interesting. Is the Trump put no longer available to the market? Remember, when he came into office, everybody believed that he will do whatever it takes. At the end of the day, he will keep Wall Street happy. That's not what the president is saying right now. He says yesterday, markets are going to go up and they're going to go down. But you know what? We have to rebuild our country. This is in line with comments that were earlier coming in where he said the economy is going through a transition. So watch the commentary very, very carefully. It's not what Wall Street was really prepared for. Let's move on. We've spoken about equities. Let's talk about bonds and currencies and what was happening there. And the movement in yields was about 4 to 7 basis points, depending on which one you're looking at. The 10-year has now pulled back up to 4.27, so a little bit of a rise in yields. The spotlight continues to be on the inflation number. Today, the US will look at the CPI number. Tomorrow, it's the PPI number. The CPI number is expected to show an increase of 2.9%. This is February CPI in the US. year-on-year increase, 0.3% if you're looking at it month-on-month. Extremely crucial. It's all about inflation, and inflation expectations are these, tariff worries feeding into the expectation on inflation going high. So that's why that data is extremely important. The dollar, at the DXY level, the dollar is still, it's just below 104. But it's a lot about, individual trading partners and how currencies are moving. Against the Canadian dollar, the US dollar actually rose yesterday. The Canadian dollar was under pressure because of all this tariff talk. Against the euro, the dollar continues to fall. The euro rose another 0.7% yesterday, now almost 109. I mean, historic levels for the dollar euro as well. That's how it kind of played out. Oil has been very range-bound. The good headline that we got was that Ukraine now finally, after that whole showdown in the Oval Office, Ukraine has relented and they're ready for a ceasefire deal if Russia agrees. So there's some breakthrough over there. Not much movement in the oil markets, actually. Oil is still very range-bound. But that was the other headline. Now, for us, the market was resilient, like, we've been talking about it. Extremely stable, one could say, in the face of this absolute global volatility. The bulls will hope, even if we can consolidate with a positive bias, slightly outperform global markets, the bulls will take it with both hands. And hopefully the slam and dunk and the negativity around IndusInd Bank, that poison is already out of the market. So we can start getting some stability even in the bank nifty. That's what I'll watch out for. Along with banks, I'll also look out for telecom stocks. And Rima will tell us why in just a bit, because imagine this. Mr. Sunil-Bharti Mittal was fighting this at global platforms, at local public platforms for the longest time against Starlink. And now I think it's that philosophy that if you can't beat him, join him. So that was a philosophy perhaps that was playing out, because Bharti has announced that tie-up with Starlink. Starlink still needs to get its permissions to roll out in India, but that was a big one to watch out for. And in addition, PB Fintech is a stock that I'll watch out for, because now we have the numbers. They're talking about this healthcare foray. Yesterday we got the numbers, 700 crores. That's how much they're putting to work. So it's sizable money. That's another one on my radar. Guys.
Well, there was one more headline from Trump that caught my attention. Is in the morning, one of the correspondents, ABC News correspondents, asked Donald Trump about the recession, right? Because it was the recession fears which roiled the markets over the last 24 hours. And this is what he had to respond. He says, I don't see it at all. I think this country is going to boom, but as I said, I can do it the easy way or the hard way. The hard way is what I'm going to do, but the results are going to be 20 times greater. So he's downplaying the recession risks after raising it just 24 hours back. And even Commerce Secretary Howard Lutnick defended Trump's economic policies on Tuesday, saying that it's worth it, even if it leads to a recession. But as of now, Trump has downplayed the recession risk. That's the key takeaway. Now, getting back to that FI sell figure, on Monday, this FI sell figure was sub 500 crore rupees. 485 crore was the net sell. Yesterday, we got a massive 2,800 crore in terms of an FI sell, and that would worry you. But here, I just want to add that maybe it's a lot to do with IndusInd Bank, because IndusInd Bank's delivery volumes was about 2,200 crore rupees, and we know the FIs own about 25% in IndusInd Bank. Now, onto the levels to watch today, just in the near term. Yesterday, we closed around the 22,500 mark. The key levels to watch on the way down, 22,314. That was the intraday low yesterday. And the high would be 22,676, which was the intraday high on Monday. So keep your eye on these two levels. Well, what will you watch today? Just a quick recap, because we've discussed this. 25% tariffs on steel and aluminium come into effect from today. US CPI inflation print. The AMFI data for February, as we've been highlighting, especially because the February DMAT additions were at a 21-month low. So the AMFI data, the faith, if the retail investors continue to pour in money in the Indian equity markets, it will be sort of a litmus test after the kind of mayhem we've seen in the markets. And important macro data from India, Feb CPI and the January IIP data.
Well, that's right. And I'll get back to the point when things are a little bit wobbly, do what's in your control. And it seems, the Indian markets, both on the policy front, whether you're looking what the RBI is doing, what the government of India is doing as well, and also the domestic flows have been good. So India seems to be a rather good place to be in. Now, the top cues that we look at, the Troika, well, that's well behaved. And that's something that's holding us in good stead. Dollar index is down, you have crude that's lower, and the yields as well, the 10-year yields, more or less stable. So that screen is working in our favor. Yesterday's performance was very, very encouraging. The final tick on the Nifty was at the high point of the day. So it was a resilient performance coming from the Indian markets. And the broader markets as well, pockets did very, very well. In fact, the mid-cap index was up. And now the margin trading book that had gone to 85,000 crores odd, that's come sub 70,000 crores. It's at around 69,000 crores. So a lot of that margin triggers that were getting called out and were getting, pulled out, that seems to be more or less factored in because the margin book has come down. It was actually 85,000 crores plus, and then gradually it's been coming down. So that's good. Some of the poison out of the system. And off late, if you take a look at 2025, you'll say, well, the Indian markets have underperformed. Yes, we have underperformed, but just take a look at what we're doing in this month itself. Gradually, we're performing in line with the emerging markets. And in fact, I won't be surprised if we start doing a relative outperformance from here on because valuations are far more palatable and domestic flows expected to remain quite solid. The pain point, that's the FI selling. That's been the problem pocket. Well, in the recent downtick that we have seen, they've sold close to around 28 billion odd. The previous time that they sold a lot was, in 2021, 2022, when they sold $32.5 billion. So 85% of what they did that time around. And this time around, we've already corrected close to around 15 to around 16%. In yesterday's trade, yes, there was a net sell number coming in from the FIs in the cash market, but there was some buying as well that we saw in stock futures. So there was some part of that was that arbitrage that we have been talking about. Sell in the cash market, and they're buying in stock futures as well, and they're net long in stock futures. Yesterday, the markets ended up. The India VIX as well popped up very, very little. It was up close to around 0.5%, but the India VIX has been very, very well behaved. It's still holding sub that 15-16 mark, which is very, very important, indicating that there is some bullishness that's creeping back in. The options data comes up for you in the screen, and there was some put writing as well that we have seen yet again, which takes us straight to the levels. On the downside, 22,250, important mark that you're looking at. That's the near-term support that you're looking at. The firmer support comes in at around 21,800, while on the upside, closer to around the 20 DMA, that's the mark you're looking at. On the Nifty Bank as well, we're in that range. On the downside, that 47,700, that's the level that we visited yesterday as well. That needs to hold out. While resistance comes in at around that 49,000 mark, which would mean that we get past the 20 DMA. In terms of stocks that I'm looking at, IndusInd Bank, well, that's been the stock in focus. From the group company itself, yesterday, Ashok Leyland did see some selling pressure. And because the group now, in fact, is in a bit of a, is in the spotlight for the wrong reasons, because that trust issue has hurt in IndusInd Bank, I'll keep an eye out on Ashok Leyland. Was it a knee-jerk reaction that we saw yesterday, or is there more pain in store? So that's the stock I'll be tracking.
Okay, absolutely. And take that point. Yeah, we need to watch out for Ashok Leyland as well. And Rima, take your point as well. And yeah, that's important to keep that in mind, that the selling included IndusInd.
Included IndusInd.
X of that, maybe we should still be on a good wicket.
Well, let's see. As you said, right, perhaps most of the poison is out of, IndusInd Bank in terms of selling. So today's FI numbers will be important. Mark Franklin, Deputy Head of Multi-Asset Solutions Asia and Manulife Investments, is now with us on the show. Mark, thank you very much for joining in. First, let's just, get the top-down view on the U.S. markets because they're seeing the biggest sell-off that we've seen in recent times. So one, is there reason to be bearish on U.S. equities? Two, at Manulife, do you think U.S. economy is likely to head into a recession? And three, Fed rate cuts from here on the table or off?
Good morning. The recent price action in the US equity market is symptomatic of a rising degree of policy uncertainty. And policy uncertainty correlates quite tightly with risk premia. And what you're seeing is at the start of the year, positioning was quite extended in the long direction. And you're seeing some money come out of the US equity market to factor in a higher risk premium or the return that's required to effectively take that level of risk on. Now, with respect to your second question, do we anticipate a recession? I'd go back to the point around what we're seeing by way of signaling from not just President Trump, but also Scott Bessent, the Treasury Secretary as well. They're really singing from the same hymn sheet here. Notably that the economy needs to go through a rebalancing away from an unsustainable fiscal and debt trajectory, heavily driven by government spending, more towards a pivot back towards the private sector and private sector job creation. That's going to create some downdrafts in the very short term because it will take a while for the private sector to pick up the slack in terms of job creation and spending momentum from the public sector. But first, what they need to do is reduce the deficit in order to create fiscal room to start cutting taxes, push through deregulation, which will then drive the private sector. So we do expect a moderating growth path in the US in the early months of this year, but the potential for a re-acceleration later this year. But of course, when you try to rebalance the economy, there are sometimes unintended consequences. And the moderation that you're aiming for can also run the risk of becoming something more concerning. So we remain on watch in terms of the pace of the moderation of the data. And with respect to Fed cuts, we still think that 2 to 3 cuts by the Fed this year is a reasonable base case. And interestingly, the market has now pushed back towards pricing of 3.5 cuts this year. So that comes off the back of a much less reduced number of cuts priced in at the start of the year, about 1 cut. So we are seeing quite a significant amount of volatility in bond pricing and rate cut pricing. Don't be surprised if we see ongoing volatility moving from one data point to the next, because the visibility is really quite murky at this point in time.
Yeah, I don't envy your position at all, Mark. Hi, good morning. Thank you for being with us on the show. Literally, money managers like yourselves, I mean, probably not an easy time at all to figure things out. Which brings me to the question, since you folks look at multi-asset strategies, where are you putting the money? And is India featuring anywhere in your list?
Well, first thing to say is we actually relish an environment where you have to be more selective. We're effectively earning our fees by being selective and picking those spots in the market which are more resilient in the face of rising volatility, and avoiding those parts of the market which are perhaps overbought. In terms of where we've been putting our money, we've been much more positive on bonds, treasury bonds, and high quality credit bonds in the last few months, because we saw a potential for yields to come down as the data starts to moderate. But our broader view this year is that bonds will trade in a very wide trading range. And so we are expecting some potential reversals at some point. So that tactical shift into bonds, we're looking to lock in some gains there in anticipation that as we get into the middle of the year, maybe the data will stabilize. More broadly as well, we think there's a secular appeal for commodities, whether it's gold and precious metals as an inflation hedge, as a geopolitical hedge, but also some of the more cyclical commodities, which benefit quite nicely from this tariff policy introduction, but also a structural scarcity because of underinvestment in new supply over many, many years. So commodities, we think, deserve not just a tactical place, but potentially a secular position in portfolios. Now, with respect to India, we still very much remain supportive of the long-term structural story. And indeed, growth is holding up reasonably well in India. Q4 GDP growth at 6.2%, inflation coming in a very benign fashion as food prices cool, which is quite the opposite in terms of other economies and food price inflation that we're seeing outside of India. But in the short term, we do think that this valuation reset has a little bit more to run. And India very much played a safe haven status in the last couple of years within an emerging markets context, both in terms of China's cyclical challenges, but also other markets showing some moderating growth developments and tightening monetary policy. And as a result of a bit more enthusiasm towards Hong Kong, China markets, a bit more of a weakening of the dollar in recent weeks, you're seeing some money come out of very overweight positions by foreign investors and recycling that into laggard markets to play that catch-up trade. So we think that plays out a little bit longer, but we haven't seen anything to dim our confidence in the long-term story for India. So we are on watch for opportunities to re-establish an overweight position, having gone neutral to somewhat cautious on a tactical basis in the last few months.
All right, Mark, very quickly, from the global market perspective, where does India rank? You briefly spoke about US. I think you have a view on Europe as well, China and India. So where does India rank in that order from the equity market allocation?
Yeah, so from an asset allocation perspective, we've been overweight Asian markets, top down, but selective within that. So we have liked Hong Kong, China tactically. India's been towards the low end of that rankings on a shorter term time horizon, but we are looking for opportunities to increase that ranking within an Asia context and within a developed markets context. US markets have obviously had a tough start to the year. We still like the fundamental outlook, certainly for both large and small caps in terms of earnings momentum, but we did upgrade European equities to a confident neutral about 2 months ago. And we've seen a nice tailwind from, let's say, a reimagining of the fiscal policy outlook, particularly with defense spending. Fast forward to the end of this quarter and beyond, we think that we're getting a bit more of an opportunistic buying opportunity in US equities, but it remains to be seen whether any bounties hold and are significant enough to be able to trade around. So we're kind of taking a very selective approach, case by case, month by month. But as I mentioned earlier, we haven't dimmed our views around the structural, the secular opportunities that the Indian market presents, but it's about making sure that we're sufficiently confident that the valuation reset has fully played out and we do have a longer term buying opportunity in place.
All right.
Okay, all right. Thanks very much, Mark. We'll leave it on that note for now. Let's quickly move on. We have lots of corporate interactions and market views lined up on the show as well. So let's tell you about it. At 8:35, we'll get you excerpts from our conversation with Warren Harris of Tata Technologies on the automotive output and the impact of Trump tariffs. At 9 a.m., we discuss Starlink's entry into India along with Bharti Airtel. Balaji Subramaniam of IIFL will join in with some perspective. At 9:20, our special segment Market Masters with the Citi India team comes up. We will be connecting with Surendra Goyal, Samiran Chakrabarti, Kunal Shah of Citi with their call on India macros and, of course, the Indian market. After that, Sunil Bora of Uno Minda joins in. We will discuss the company's business momentum and outlook as we step into the new fiscal. And towards the end of the show in It's the Economy, Lata today will be speaking with the head of Credit Bureau Sybil on NPAs in retail loans.
Well, time to slip in a short break, but we've got a lot of stock-specific action that we're tracking for you. We get to that in just a bit in our special top 10 segment. We're looking at Bharti Airtel, Tata Motors, SBI, ICICI Bank, IDBI Bank. All of them will be reacting to positive news flow. Add to the list, Axis Bank, you have PB Fintech, Paytm, Godrej Agrovet, and RVNL. Stay tuned. We'll get into further detail on all of these stocks that are expected to react to positive news flow.
Welcome back. So let's just pull up the Asian picture as well and get a sense of where the implied open is. Asian markets are very mixed this morning with this whole roller coaster on Wall Street. There's some green on, for instance, the Japanese market. The Hong Kong market and the Shanghai market are under a little bit of pressure, but not much, as you can see. It's barely down, the Hang Seng. Let's pull up the implied is right there. Implied is also very flat, along with the Qs in the rest of Asia. So will today be the day of recovery? You get through this opening, and then can the bulls build from there? It's also going to be a day to focus on a lot of individual stocks. There's plenty of news flow. So let's straight away get to our team for the CNBC-TV18 list of top stocks to watch. And topping that list, of course, has to be, morning to all of you guys, but topping that list has to be Bharti Airtel, Rima. So Starlink and Bharti, the tie-up is happening.
Indeed. So Bharti yesterday in a press release has announced an agreement with SpaceX to bring Starlink's high-speed satellite internet to the Indian customers. Now, right now, it's a partnership. Now, what they will explore is Starlink's equipment, because to get that satellite connectivity, you need certain equipment that will be available in retail stores. Airtel will be able to offer Starlink services to the customers, which hitherto they could not service on account of lack of last mile connectivity. They didn't probably have the cables. So it's an opportunity for Bharti Airtel also to expand its service offering to enterprises. Maybe a corporate has, some headquarters in a very difficult location, say a mining location where you don't have that much connectivity. Then you can offer it to enterprises as well as customers. So it opens up new revenue streams for Airtel. But again, we don't know how much because, satellite connectivity would be more expensive than terrestrial. So how many people would, take that on board? Perhaps it will be more useful for enterprises. The release is not saying it's going to be an exclusive partnership. Also, Starlink is yet to receive its license in India. The spectrum allocation is yet to be done, which means at least in the near term, it's not that it's going to be, immediately money is going to start flowing into Bharti Airtel's coffers. But the good part is that Airtel is not fighting it out. Instead of it being Starlink being a competitor, it's now there's going to be collaboration, right? So whatever money has to come, it will be shared between the two. So in that sense,
it's neutralized the threat.
It's neutralized the threat, right? Collaboration over competition.
Smart strategy, perhaps. Okay.
And it's not exclusive as well.
No, we don't know. The press release isn't saying that it's exclusive. Right? So who knows, right? They could just tie up with Jio as well or Vodafone Idea in the future, but we don't know right now.
All right. Okay. All right. Let's hop across to Sudarshan. He's here to tell us about Tata Motors. Sudarshan?
So good morning, Nigel. Tata Motors CFO held analyst meet yesterday, and the commentary coming out of that is largely positive. But first, talking about the stock is near 52-week low. It's down 12% in the last 2 to 3 months. Now, talking about the commentary, first on the JLR front, it maintains Q4 guidance, Q4 EBIT margin guidance of 10%, and it says that it will be net debt free by FY25 end. Now, on geography, it says US is progressing well. In EU, the environment has been less challenging that company had expected. In China, it's saying that it's outperforming industry, and for UK, it's saying that it's improving well. On domestic front, it says that CV segment has been doing good, but PV has to see an improvement, and going forward, the focus has to arrest market share loss, especially in the small CV segment. Even brokerages are largely positive on the stock. Nomura has a buy call with a target of 861. Macquarie has an outperform call with a target of 826. CLSA has high conviction outperform call and target is 930. Goldman Sachs has neutral stance, target is 690. And Nuvama has a reduced call and target is 720. But I'm going with green on Tata Motors on the basis of commentary coming out of the analyst meet.
Thank you very much for that. You know, we were just talking about how the Bharti press release doesn't say it's an exclusive partnership with Starlink.
Well,
it's not because Jio Platforms has just announced that they too will be bringing SpaceX Starlink high-speed internet to all its customers. So SpaceX Starlink has tied up both with Bharti Airtel and Reliance Jio. Now, do they tie up with Vodafone Idea also? We'll have to wait by to see. But for now, Bharti Airtel and Reliance Jio.
So now they have to compete with each other, not with Starlink and Mr. Musk, because he's anyway tied up with everybody for last mile connectivity, because these companies know the Indian market, right? So he will continue to sell his services. It's between Jio and Bharti to fight and figure out who can do a better job.
So, you know, all these big major, telecom company heads in India, they've always said that satellite connectivity should be used more and should be seen as something for greater good because 40% of the Indian population is still not connected to the internet. And the problem is last mile connectivity. It's very hard to put cables, etc. So therefore, we are trying to serve a greater good by providing them connectivity through the satellite. So, that's always been the philosophy behind this, the satellite expansion and satellite communication. So now they'll all come together and provide all Indians connectivity.
Well, that's the greater good, of course. And whether it starts impacting any of the, the wider services as well, we'll find out. 9 o'clock, a full-blown discussion coming up on this with the analysts and experts at IIFL. So wait by for that. We'll get you more on this. And that's the news on the screen, that it's now not just Airtel, but Jio is in this as well. They also have announced a tie-up with SpaceX's Starlink, high-speed internet to customers. Remember, Airtel was saying that they will be selling a lot of the Starlink equipment through their retail stores, etc. So we'll see how this plays out. But let's quickly move on. More stocks in news as well. And a lot of banks are going to be in focus because this big resolution plan for JP Associates. Let's find out what's the latest on this one. Ritu, good morning.
Good morning, Surbhi. Green for banks because, it's a landmark resolution nearly a decade in the making. 25 banks led by State Bank of India and ICICI Bank have finally executed the transfer of the stress loans belonging to Jaiprakash Associates to NARCL, which is the National Asset Reconstruction Company. Now, against the principal outstanding of 14,500 crores, banks get 12,000 crores from NARCL for the sale. Of course, the total outstanding debt for JP, including all the overdues, interest and penalties, since it's been an NPA since 2016, is well over 52,000 crore rupees. Now, the deal, we understand, follows that 1585 structure. So 1,800 crores of cash gets paid upfront and the rest in the form of security receipts. And it is going to reflect in the bank's balance sheet in the current quarter itself. So you have SBI alone recovering about 500 crores in cash, another 2840 crores in the form of security receipts, while ICICI Bank, IDBI Bank, Axis and others also secure some recoveries. Meanwhile, the insolvency process will continue. The EOI submission deadline has been extended to the 25th of March, and the final recoveries for banks from security receipts are going to depend on the IBC process.
Okay, all right. Thanks a lot for that, Ritu. Good to see you early in the morning. Well, let's hop across to Sapna. She's here to tell us about the news flow on Paytm. Sapna?
Well, what we have picked up is the fact that, the government may be reconsidering the exemption that has been given in terms of the merchant discount rates to UPI as well as the RuPay cards. If you recall, way back in 2020, from 1st Jan onwards, this exemption had rolled out. The finance minister had made a specific announcement in December 2019. But having said that, the way the digital payments ecosystem has grown, there are indications that capital is required for further investments and further growth. That's one aspect. Second, I think the government would also be liking to have a kind of a level playing field with the private card issuers like your Visas and MasterCards, where the MDR very much continues, but there's nothing on RuPay cards. And third aspect, of course, even while reconsidering this and doing a rethink on this entire matter, what they would like to emphasize is that if in case the MDR as a revenue model comes back, that cost should not be passed on to the customers. Well, all of this is at a very preliminary stage. Let me clarify that. But having said that, there's a serious rethink going on within the government circles on this matter. And probably over the next couple of months, we should hear something about this.
Thank you very much for that. It's over now to Vamakshi for the latest on Godrej Agrovet.
Well, good morning, Reema. You know, the stock will be in focus because they will be acquiring the residual 48% stake in Creamline Dairy Products. This acquisition will be done for nearly 930 crores, and after this, it will become the wholly owned subsidiary of Godrej Agrovet. Keep in mind that Creamline Dairy is engaged in milk procurement, processing of milk, manufacturing and selling of milk, as well as some milk products. Now, when we talk about the valuation, at the 48% stake for 930 crores brings the company's valuation to 1,935 crores. The revenue for the company in FY24 was at 1,540.5 crores, which puts the price to sales ratio at 1.26 times. So overall, given this development, going with the green for Godrej Agrovet.
Okay, all right. Got that, Vamakshi. Thank you very much for that. Let's move on to Yash. He's tracking the developments at PB Fintech because, like I was saying earlier, now we have the numbers. This healthcare foray, they're almost putting 700 crores to work. Yash, on this?
Well, that's correct. This was awaited, the monetization value unlocking as far as the healthcare vertical is concerned, and the process has begun. What PB Fintech has informed the exchanges is that they would be infusing. This is the PB Fintech listed entity, would be infusing about 696 crore rupees to own a 33.63% stake in the healthcare foray, that is PB Healthcare. Now, this is with respect to PB Fintech, but certain senior employees of PB Fintech as well as the founder would also be infusing some money into the PB Healthcare or the healthcare foray. Yashish Dahiya would be infusing 87 crore for a 4.2% stake. 43.5 crore would be infused by co-founder Alok Bansal for a 2.1% stake. Sarabveer Singh as well as Mandeep Mehta and Bhaskar Joshi would be infusing 2.25 crore per 0.11% stake. A total of about 40.04% stake being given out through this particular transaction for a total infusion of 828.75 crore rupees. Left with is about 60% stake, and that will be very important because that will get money into PB Fintech and of course the healthcare foray itself from other investors. And this is just, just to put a number to it, this transaction has happened at a valuation of nearly about 2100 crore rupees.
Okay, all right, got it. So PB Healthcare, another stock on our radar today. Yash, thank you for that. Let's quickly recap the list then of all the stocks that we need to watch out for. The ones that have positive news flow around them: Bharti, Airtel, Tata Motors, SBI, ICICI Bank, IDBI Bank, Axis Bank, PB Fintech, Paytm, Godrej Agrovet, and of course Reliance Industries. This is on the back of the Starlink development that's just come in today. No stocks actually that have negative news flow and that may open in the red because of negative news, that is, at least. Well, that's equities. Let's quickly figure out what's the latest in the world of commodities. We have Manisha joining in. Manisha, 25% tariff, 50%, now it's back to 25%. It's too much, right? But you tell us, what have you been tracking over the last 12 hours?
Oh, well, absolutely. So the chaotic implementation of tariffs is leading to a lot of uncertainty into the markets there. Well, as you said, we do understand that 25% tariffs on steel and aluminum go into effect today and not the 50% on Canada. But we also do understand that the US and Canada will hold negotiations this week on trade and tariffs. So the story is far from over. You will continue to see very, very volatile trades happening in metals. But in the meanwhile, overnight, as the street was reacting to all of this in the New York session, we've seen prices actually gain for many of these metals. Steel prices gained up by a percentage point. Iron ore prices have been holding around 2-month highs. Copper jumped up by 2.5%. We saw silver gain up by 3%. Gold was up 1% as well. The US dollar index trading at a 4-month lows clearly has been supportive. And the markets will watch out for the US inflation data that comes in today. And this is going to be the most important number to watch out for ahead of the US Fed meeting, which is on 17th and 18th of March. So clearly, there's a handful of stuff to watch out in sense of global events, and the market continues to be quite volatile.
Thank you, Manisha, for that important update on commodities. We'll slip into a very short break. On the other side, we'll connect with Deven Choksi for some fundamental stock talk.
Welcome back. Well, the markets are indicating that we open up more or less flattish, but for the time being, let's get some fundamental analysis going. Devin Choksi of DR Choksi FinServ joins us on the show. Hi, Devin. Good morning. Always good to see you. And I think the markets are in a better space in comparison to maybe the last couple of weeks or so. So that's good news. Let's focus on a couple of names. Yesterday, IndusInd Bank was the big casualty. The stock lost more than 25% of its market capitalization in a single day. And the problem is not valuations, the problem is now trust. And that's why, on a 2.5% impact, you see the market capitalization getting eroded by close to around 30%. What's your view on the stock? And also it had a rub-off effect on Ashok Leyland. And now the fear is maybe, in fact, some of that promoter pledge will come into question. Your view on both these two names?
Hey, Nigel. Good morning. Well, I think without getting into what the domino effect it could have, I would think that on the fundamental merits, the IndusInd Bank probably, I think, will have to absorb this amount, I think, which they already said that they will. And maybe I think they have to get along with the entire subject hereafter. But more important aspect out there is that such a big item, I think, remains absent as far as I think the controlling mechanism is concerned. And as a result of which, I think the disclosure has not taken place. Both these issues, I think they go side by side. On one side, I think the hedging mechanism remain absent in this particular transaction, amounting to such a huge amount of loss. And on the other side, I think the reporting mechanism also remain absent. And that is where the issues of trust arises. At this point of time, though the price is significantly corrected, the downside may be less comparatively. But enough amount of confidence to gain, I guess I think one will have to pass through a quarter's result. And thereafter, one can possibly look into this particular stock of hedge.
Since we're talking about IndusInd Bank, maybe we can get to those bites as well, because we did speak with Mr. Sumant Katpalia. This was just after market hours yesterday, and got his sense and his explanation about everything that's transpired, the massive destruction of wealth, and how the board as well as the management plans to win shareholder trust back. Take a look.
During a review of the processes in connection with the compliance to the RBI circular on investments portfolios, we found that there were some gaps which were coming out. And that was really the start of the issue. We found this anomaly around October, and that is where we started our internal assessment as well as we hired an external agency. At that point of time, we did not know the difference, and we knew that there were two deals getting accounted incorrectly, but there's so many deals in that, so we did not know the real impact. And I think as soon as we got to know the impact, we held a board meeting and we informed our board and we did the disclosure. You know what happened. Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU, and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
Okay, so that's a statement on sort of getting back to business, Mr. Katpalia. But let's see if the market is willing to, show it some love again, because yesterday it was real break in perhaps confidence. That's what we saw yesterday. Anyway, beyond IndusInd Bank, Devin, hi, morning. More stocks to discuss with you. I wanted to put the spotlight on PB Fintech. I don't know if you caught this or not, because they announced this healthcare foray a while back, right? I mean, the intention is to create some sort of maybe a network of hospitals or something very specific so that they can keep costs in check. And now they're talking about infusing almost 700 crores in this company, PB Healthcare. How do you view the company and the stock?
Yes, very good morning. Well, I think without getting into specific at this point of time, because I don't have complete detail in front of me, I believe that the healthcare market per se, I think, is growing and growing exponentially as far as I think the country's overall population is concerned. Now, given the kind of strength that they have demonstrated in the platform business, I think if they end up creating a similar kind of a impact, probably in the healthcare segment, it could mean that significant amount of business to talk about. How they integrate themselves with the hospitals and other healthcare facilities is something which one needs to study based on, I think, the business model that one they will probably disclose at some point of time. But the size of the healthcare market remains, I think, absolutely very convincing. And any player, I think, trying to integrate themselves into this particular business could possibly see better times going forward.
Okay, all right. That's on PB Healthcare. Deven, let's talk about the other big story. Starlink seems to be all set for its India entry. I mean, they still need to get government approvals, regulatory approvals, but they've tied up with both Jio as well as Bharti Airtel. What's your sense? I mean, I don't know if this is going to cause any sort of meaningful impact in terms of earnings, P&L in year one itself or not. But what would your call be on both the stocks? I mean, on Reliance as well as on Bharti in light of these developments?
Yes, I think this has been a missing link in both these companies as far as I think providing the broadband services to the satellite is concerned. Though I think both these companies have created their own setup, I think, for that, but still, I think this is an important tie-up that I would call it as. Even though I consider that out of 140 crore population, I think the uncovered segment of the population would be somewhere around between 9 to 12 crores, which is less than 10% of the population. It may remain uncovered through the current fiber network, the wireline network, and not forgetting the fact that government is significantly putting money in the fiber for BSNL to go to the last mile connectivity. Given the kind of a situation of a small population still remaining uncovered, I would like to think that largely this particular tie-up could possibly offer some of the related services in the defense as well as in the healthcare, which could possibly be a meaningful kind of a use of the satellite-based communication that these two companies will be providing. There is a rough cut estimate available about the size of the market, which is close to around $19 billion, but that needs to be established. I don't think that I think immediately one can count on that particular aspect. But yes, I think this is one missing link it was in the business model of both these companies, which is now getting plugged in. And should the regulatory clearance come in, we'll come to know about I think, how they roll out the business models.
Okay, all right. Deven, what about Tata Motors? You know, there were, the management met various sell-side analysts. The stock has seen a sharp pullback from the top. Do you think it's a good time to get in now?
Yes, Nigel, absolutely. I think the correction in the stock price is probably more than warranted. I think that the fundamentals of the business remain absolutely strong and convincing. In the passenger vehicle segment as well as in the commercial vehicle segment, I think this company has given, I think, a good amount of direction about how to manage the cost and grow the market share in the business. Passenger vehicle is a classic turnaround story that they have demonstrated, including in electric vehicles, wherein they have been early starters in this particular line of activity and have created the impact in the market by way of producing the profitable business. And same is situation with commercial vehicle, which is getting demerged from the mainframe Tata Motors in the current year. So obviously, I think we are likely to see the larger amount of growth coming into this particular business. We remain distinctly confident about the possibilities of some kind of synergy of the tie-up with the global markets opening up. And maybe I think some of the global companies want to take plunge in India. They may probably look at the synergetic tie-up with companies like Tata Motors. So that is a good possibility which can be ruled out. So current level, yes, I think everything is discounted in the price. Maybe the stock demands, I think, a fresh look into the portfolio.
Okay, all right, Deven. Good hearing your thoughts as always. Thanks a lot for joining in. Wishing you a good trading session ahead and looking forward to chatting up with you in the coming days as well. Well, time to slip into a short break. Up next, Sudarshan as well as Mitesh, they're waiting for us. They'll give us how do they see the markets pan out on the technical front. Stay with us. Welcome back. As promised, we have Sudarshan and Mitesh who are both standing by. Good morning, gentlemen, and good to see you. Ben, Sudarshan, let's start with you first. Yesterday, you said, dips should be used as buying opportunities provided the 22,250 level holds out. That's the way it panned out. So good on you. What's the trade for today, and where do you see resistance coming at?
Yeah, good morning. I think the trade continues. If you have a position, keep it. If you don't have a position, wait for intraday dips. They may not be as deep as yesterday, but they'll come and go long. It's always better to buy at a lower price, especially when the trend is not clear. So the trade is short-term trend remains intact. We have seen how the markets bounced back yesterday. So be long, and to your second question and where resistance could come in. See, once markets pick up momentum, resistance becomes immaterial. But even then, somewhere around 22,750, 22,800, I would expect the markets to pause if it goes there.
Okay, all right, got that. Mitesh, let's come across to you. What's your trade this morning? The GIFT Nifty, at the last I checked, from indicating a negative 50 points opening, it's now indicating a more or less flattish start. What do you do?
I think, I've been looking at the charts, and now I think there are first signs that on the daily charts, till now I think all the reversals were on the intraday hourly to hourly charts. Now I think there are first signs that we might be willing to move higher, because a lot of indicators are turning the direction from oversold levels. And while, there are significant supply pivots on the upside still left to be captured, I would, unless until we break 22,300, I would bet for a retest of 22,600, 650 zone, which is where there was a gap last Friday. And once that is being cleared, then I think we should head towards 22,750, 800. And beyond that, we get into a much stronger up move. So I'm considering that possibility is a very strong outcome which could happen over the next few days. So in that sense, I'm positive. My reversal point will come in case we see the Nifty start trading below 22,300 levels.
Okay. All right. So hopefully playing for a recovery and bounce. Got it, gentlemen. Let's come to stocks as well. Sudarshan, what would your list look like?
Well, it's mainly buying. Tata Motors is a buy with a stop at the 624. ABB is a buy with a stop at the 5,000. I have one intraday short, that is CDSL, Central Depository. It's an intraday short with a stop above 1150. And finally, CAMS, which has gone through a very deep correction, is now a buying opportunity with a stop under 3,200.
Got that. Mitesh, morning. What would your recommendations be?
Yeah. I have all buy calls in line with my outlook, which is slightly on the positive side. So Ambuja is a conditional buy. If it starts getting past 498, buy with a stop at 490. Look for a first target of 515. A buy on Asian Paints with a stop at 2270 for a target of 2340. BEL is another one which is looking good. Buy here with a stop at 270 for targets of 290. And after a long time, I have a buy on DMart with a stop at 3590 for targets of 3720.
Okay, got that. Mitesh, just a quick question on IndusInd Bank. I mean, of course, levels to watch, yes. If someone's still stuck, if someone couldn't get out yesterday, what would your advice be? And typically, when you've seen this with other big stocks, some event, some issue, when suddenly there's a collapse, 10-15% collapse, is there any lesson that one can take or any parallel that one can draw from the past? I mean, what should traders be doing with the stock that's gone into a free fall like this one?
I think the parallels are bad. I think I remember D1 Housing Finance and Yes Bank going through some accounting issues. Now, I don't know how serious this issue is, because obviously I'm not the one who is looking at balance sheets, etc. But just looking at the long-term charts, the damage is clearly there. I was hoping that if this decline could get arrested around 750 odd levels, which is where the markets had bottomed in June of 22, you could at least do some base building and try and look for some reversal. But now I think it looks like we are looking at 600 as the minimum, and in a worst-case scenario, even 525, 530. So to me, it looks like it's just selling rallies. I think that's the way I'll approach it.
Rally. Got it. Need to take a very quick break. We'll be back with the pre-opening trades in just a bit and a conversation on the telecom space.
Welcome back. Just awaiting the pre-opening rates. But in the meanwhile, today is also a big day for bond markets. The RBI will be buying via an auction a massive 50,000 crore of bonds. Also, the February CPI is due today at 4 p.m. along with the January IIP data. A CNBC-TV18 poll sees the Feb inflation number sub 4%. Lata is here with us in the studio with more. Lata.
Well, the CPI number is going to be something people will watch out for, because future rate cuts will depend on that. And it's almost certain that that number is going to be below 4%. So clearly that once you see that number, you can expect the April rate cut. The important number will be the food CPI, because that's the one that's been between 8 and 11% for the better part of last 18 months. So that's going to fall all the way to below 5%, probably for the first time in 2-3 years. That number will be closely watched. The average we got in our poll is 4.1%. And core CPI will start inching up because of the low base, and that's expected to come at 3.8. The industrial output is not a number people watch out for. But anyway, the average over there that we have got is 3.2%, which means clearly industrial growth is not going anywhere. The key point is that it's a big day for bond markets, as you pointed out. It's not just that you will get a CPI number which is 3 point something, which is always a matter of exhilaration. But I can't remember when the Reserve Bank, if it ever bought in one shot, 50,000 crore of bonds. So it's going to be big in that sense. Will the market move? My guess is it won't, because both these are well telescoped events. You know, for the longest time, we know that February inflation is going to fall. And we know, at least for the last 2 weeks, that the Reserve Bank is in liquidity infusion mode and will buy this 50,000 crore. So it's well telescoped. Also, people will be worried about the US CPI number, which is going to come later in the evening, after all this data, after our bond market stop trading, and that number is expected to be probably south of 3. If it is south of 3%, then it will be considered good for bond markets. So 2.9 is what the polls are throwing up. The real fall in bond yields in India is going to happen probably next quarter, when clearly the supply is going to be much less than the demand. Foreign funds coming back, RBI also buying, and a rate cut expected, probably too. So we'll really see a rally only afterwards. For the moment, it's all in the price.
Thank you very much for that. But the big story is what's brewing in the telecom space, where Elon Musk's Starlink, which is under SpaceX, has tied up both with Bharti Airtel and Reliance Jio to provide satellite communication. Now, this is primarily to serve, remote regions where it's very difficult for the cable or wire to reach. So the underserved areas is what they're planning to tap into. But remember, as of now, Starlink does not have the required government approval. So it's not going to be an immediate, the revenues for the telecom, both Bharti Airtel and Reliance Jio, will not immediately accrue. And the other important point to note is that globally, it's also very expensive. India's terrestrial networks particularly are very affordable. But Ashmit is here with some more regulatory hurdles that Starlink could face. Ashmit.
Well, it's an important clarification that you've given, that both Airtel as well as Jio, while making their announcement about their tie-up with Starlink, were careful to point out that as far as this entire process going forward is concerned, it is subject to Starlink's securing necessary approvals. So what are these necessary approvals? What are the regulatory issues that Starlink will have to watch for? There are 3 aspects to watch. Number 1, Starlink will have to secure authorization from InSpace, which is essentially the Indian National Space Promotion and Authorization Center. There's a standing committee that comprises of the Home Ministry as well as the Department of Space. Necessary approval and authorization from them to allow for these connection services, mobile connection services through satellite, is something that they'll have to secure. We're given to understand that they've made this approval is in advanced stages. They've made various submissions. There are concerns that were raised by the MHA as well as by the Department of Space, which Starlink is trying to address. So that's one, that's the first step that Starlink will need to clear. The second is an operator's license from the Department of Telecom. That will be the second key hurdle. We've spoken to the Telecom Minister previously, Jyotiraditya Scindia. He was careful to point out that there are still some niggles left, especially from a security standpoint, that Starlink is yet to resolve. And this entire process going forward will be subject to those satisfaction, the Indian government satisfaction of those security concerns. So Starlink is going to have to satisfy those concerns and then subsequently procure and the clearance from the DOT as far as the operator's license is concerned. The third aspect, and this is with respect to the TRAI, this is with respect to the spectrum. There has been a fair bit of debate ever since the Telecom Act was brought into place as to what will be the nature of spectrum allocation. Will it be allotted? Will it be auctioned? The view that has been coming from the DOT consistently, and we have spoken to the telecom minister on this as well, is that spectrum, especially for satellite services, given that it is a shared spectrum, will be allocated administratively. The question there is, what will then be the pricing of this allocated spectrum? That issue has been referred by the DOT to the TRAI. The TRAI is currently considering it. It has invited applications from various stakeholders. It has invited feedback from various stakeholders. Is yet to give clarity. but that will be the key to this entire aspect. You pointed out the pricing. Starlink is concerned. But if that is to be made affordable, if that is to be made comparable to the terrestrial networks, the pricing of this will again be critical for Starlink and any ambitions that it has in terms of widespread penetration.
No, absolutely, Ashmit. And many of these debates were very public debates. I think events that you were covering in Delhi, I remember at the Bharat Mandapam, I think it was the India Mobile Congress, right, where Mr. Sunil-Bharti Mittal was making a very, very sort of public plea to say that maybe it should be a fair treatment should be given to all. A lot of Indian companies have put in millions and billions of dollars to roll out these terrestrial networks. It's very interesting now that these companies have actually tied up with Starlink. So maybe some of the background parlays have also led to some positive conclusions. Thank you very much for that. Let's actually take this forward with our next guest. We have with us Balaji Subramaniam, Vice President at IIFL Securities. Balaji, I want to pick up on that last part first. We'll come to, P&L impact and etc. later, if at all. But the issue here is whether Starlink, whenever it comes in India, how much will it have to pay for that spectrum? Like our colleague Ashmit was telling us, that it will probably be allotted. There's going to be no bidding war as such. It'll be allotted spectrum, Starlink pays, and then they onward tie up with Jio and Bharti to roll out this network. Ashmit was making the point that if it's subsidized to the extent of, to boost rural connectivity, etc., if the government decides to be a little charitable, then could it start competing with terrestrial networks at all? I mean, how should we understand this development?
Hi, good morning. Thanks for having me on the show. So my reading of this situation is that we have to see what exactly is the pricing modality that TRAI comes out with, and whether there are any revisions to that based on incorporation of feedback by DOT, etc. But my sense is that these would be the satellite services would be used to extend coverage into areas where currently as in there are challenges in terms of getting those areas connected through terrestrial means, either through mobile or through FTTH. So, my reading is that at least in the foreseeable future, I don't see any risk of disruption or cannibalization to terrestrial services from satellite, simply because, one, there are multiple technological challenges that need to be addressed. Some of them are being addressed, credit to the team at Starlink. And on the other hand, you also have affordability challenges, especially in a country like India, where you have mobile ARPU, which is less than $3, and you have unlimited fixed broadband plans starting at less than $5, which is not the case with many of the other markets, including the African markets where Starlink is present right now. So
what's the pricing? Balaji, just a second, and that's why it's really important to understand how this works. What is the pricing at which Starlink operates in some of the international markets? You mentioned they're in Africa. I mean, that'll be a great sort of example for us to look at, because the whole point of getting them in to boost rural connectivity, to power up schools, etc., it'll have to come at an affordable price. I mean, rural schools cannot afford to pay top dollar. So how much is the pricing for Starlink services internationally, just to get a sense?
So it varies across markets. So in developed markets like US, Starlink plans start at $80 per month. So, that is clearly quite expensive, especially from an Indian standpoint. Even in markets like Kenya, which is, as per my knowledge, the market where Starlink offerings are priced the lowest, there you have plans starting at $10 per month. And that offers 50 GB per month limited data. So it is not like India, where you have Jio and Bharti offering unlimited fixed line plans starting at $399 or $499 per month, depending on which company you are looking at. So, of course, the speed, there are speed considerations, but at least the data allowance is unlimited. While even in a market like Kenya, the $10 plan of Starlink comes with a 50 GB monthly data allowance. So I think, if Starlink has to match someone like a Jio in terms of terrestrial pricing in India, that is going to be a stiff ask.
So Balaji, a couple of questions. What could be the revenue opportunity? Because we know that the underserved region in India, underserved population in India is about 30 to 40%. So if we have to provide connectivity to them, what could be the total addressable market, which is now going to be shared between all these? And what about the timeline in terms of revenue accretion?
So the way I think it would work is with both these telcos now, tying up with Starlink. For starters, what Starlink will be getting is they will be getting the distribution reach of both Airtel and Jio, while each of them has more than 1 million retail outlets, at least in the areas where it makes sense for these companies to sell Starlink's offerings. At least those retail outlets will act as distribution channels for Starlink. So even though you talked about the geographical coverage number, let us not forget that both Jio and Bharti have north of 95-96% population coverage. So geographical coverage may be lower, but population coverage is also equally important, or rather more important in my view. My sense is that especially in places like, say, jungles or deserts, or even in the seas, where it is very difficult to have a proper terrestrial infrastructure, that is where Starlink's offerings will come in handy. So if you're a Jio or an Airtel subscriber who is roaming on to some of these areas, there you will get seamless coverage. As far as timelines are concerned, it is very difficult because we are still in very early days. Starlink is yet to receive regulatory approvals, including license, spectrum. So we don't know how long it will take by which all these are in place. And even once that all that falls in place, I think it will be more of a gradual process. It will also obviously depend on what is the pricing of both the Starlink terminal and the services. So there are multiple moving parts here, and we are still in very early days.
There's also a price associated with the device, the terminal. So can you tell us how expensive that is? And is it possible to summarize to say that B2C, that the regular consumers like you and me are not going to use Starlink services, even if we go to a remote location, but it's going to be an enterprise opportunity? Corporates in these regions where there is poor connectivity right now are likely to take on this service, and therefore they will be okay to pay 3x, 4x more in terms of pricing.
So that is right. So you have, Starlink device that is sold at $350 in a market like Kenya. I think in the US it's even higher. So these are pretty large sums for a retail customer, especially in India. Even for a high-income postpaid customer, unless he's a sailing enthusiast or he has some hobbies which takes him to the seas very frequently. I don't see anyone spending this kind of money, especially for having coverage in which may be of use to him very infrequently. So I think that is something which is very clear. In the enterprise space, there may be, that is where probably, the more action could be, where enterprises would like to have access to, network all the time, and they don't mind paying a bit of premium as long as the security aspects and all are, taken care of. So that
Balaji,
is how I see it.
So Balaji, 30 seconds market, we're hitting market opening. Basically, is this a potential threat averted for Jio and for Bharti? What is the net takeaway? Is it absolutely neutral? Is it positive because now there is no overhang of competing with Elon Musk? What's the final take?
So in the near term, it is going to be neutral. And I think the very fact that they are tying up means that, one of the, at least some investors had a worry that this is going to be a disruption. At least, that disruption risk kind of, that overhang goes away, because even though the telcos were telling that there is no risk of disruption, but, I think actions speak a lot louder than words.
Right, thank you very much for making sense of this big development for us. We'll watch out for how telecom stocks open up.
Okay. All right, well, we've got stock of the market then. First rates coming in there. The Nifty puts on a half a century. That's great news. 50 points higher after ending yesterday at the high point of the day. So good going out there. What's gaining? Bharti Airtel. That's up close to around 1.5%. Reliance Industries, the big boy in there. That's up close to around 1%. So both those two posts that Starlink, tie-up, both of them are higher. Good going on that front. Power Grid, that's up close to around 1.5%. And BPCL, the decline that we saw around crude oil prices is working well. I think Avendis as well has come out with the note. They have upgraded HPCL, upgraded IOC, and they maintain their buy rating on BPCL. So those stocks are doing quite well. What's not doing well? IndusInd Bank. After yesterday's, 27% cut, it's down another 4% or thereabouts. So that stock is taking a hard knock. And I think there's a downgrade that's come in from Motilal Oswal on some of these tech-related names. And some of them are reacting. HCL Tech is down close to 100%. Infosys is down close to 100% or thereabouts. By the way, keep an eye out on Bharti Airtel. That's putting on good weight now. It's up 2.5%. So that's clearly the leader this morning, holding one end up. And the breadth of the market actually is very, very good as we speak. You have close to around 4 stocks that are advancing for 1 stock that's declining. And from the broader markets, BPCL was doing well from the Nifty. HPCL is the big move on the broader markets. BSE has bounced back. It corrected from 6,000 rupees to around 4,000 rupees. Well, today it's pulling back. And PB Fintech, so-called value unlocking, Street hasn't read it positively because they're putting more than 600 crores thereabouts, in that project, that healthcare project that they're talking about. So 2.5% lower on that one.
Okay, so it started off with a flare and now it's becoming a little quiet, especially the mid-cap index. At one point in time, it was up 0.5%. Now it's about 0.2% higher. Let's take a look at some of the key gainers beyond the Nifty as well. If we talk about some of the big movers, there is Senco that's trying to put on a little bit of weight. There's HPCL, which continues to move higher, about 3% up on HPCL as well. These are some of the names that are coming up early on the screen. Let's also take stock of, IndusInd Bank and see what this one's doing. Look at IndusInd Bank, 5.5% down after a 27% decline yesterday. There's just no let up. And a lot of the literature that's been doing the rounds, reports, etc., murmurs. I mean, despite the clarification from Mr. Katpalia, clearly the market's still very, very nervous. Aside of that, all of large cap IT is still falling. Infosys, Wipro, HCL Tech, TCS, all of these stocks down. So IndusInd Bank and IT, these are the big drags on the index. And Lever is the other one, which is lower. Aside of IndusInd, by the way, the other banks have managed to pull up smartly. HDFC Bank, for instance, is in pole position, 1% higher, looking fairly okay. SBI is also up and about. Reliance is contributing on the upside. And now again, there's a bit of volatility. Again, look at the indices. Nifty is now 66 points higher, cruising along nicely. And the mid-cap index up 0.5% again.
Well, just to elaborate a little bit more on the technology names and the cut that we're seeing. So Motilal Oswal has come out with a note and they're saying that the street was expecting FY26 growth to rebound because discretionary spending was cut in FY23-24 and now things are improving. Now in the coming year, growth will rebound. But now they're saying that given the uncertainty surrounding the entire tariff, sentiment has been hit. They no longer expect discretionary spend rebound in FY26. Companies, so therefore they have lowered the growth assessment quite meaningfully. So for TCS in FY26, they were earlier anticipating a 6% kind of growth. They brought it down to 3.5%. For Infi, from 7.5%, growth is now seen at 5%. From Wipro, from +4, it's now down to just 2.9%. For HCL Tech, from 6.6% down to 5.3%. So basically, growth estimates across the technology pack have been brought down significantly for FY26 and FY27 because the sentiment, according to them, has turned cautious from January to March. Enterprises are now adopting a wait-and-watch approach when it comes to discretionary spending. So growth estimates have been slashed. One more stock, Kaynes Technology. That's the one which is plunged after MD has received a show cause notice from SEBI. I'm just trying to find out what the reason for the SEBI. So this is violations in maintaining the structured digital database. SDD relating to the company's financial results for the period ending FY23-24. So big fall in Kaynes Technology, and that one stands out on the mid-cap.
Just one point, what a lot of the sales notes are saying, that this is a show cause notice. It's not a conviction of any kind of wrongdoing as well. For the time being, the street is not taking it lightly. Stock at the low point of the day, down 8%.
Okay, all right. So that's Kaynes. another casualty of some issues with respect to regulatory misses, down 8.5% right now. Market overall has stabilized. Final tally as the opening settles is about 28 to 30 points higher on the Nifty, with the mid-caps doing a shade better. Time now to move on to our special conversation, Market Masters. Today we have with us the Citi India top team. Surendra Goyal, Head of India Research, Samiran Chakrabarti, Chief Economist, India, and Kunal Shah, Director, India Bank's Financials. Gentlemen, great to have all of you with us. Thank you so much for joining in. I could start with the banks question because that's become the hottest topic in the last, 48 hours. But we'll come to that. We'll come to banks in just a bit. Surendra, let's open with you because looking at some of your latest notes, it's quite evident that you folks have turned a little positive on the market and you're finding valuations also more palatable. So let's start there. Where does India stand now after this 5-month-old correction?
Sure. Thanks for having us on the show. Yes, we have turned more positive on India. Around a couple of weeks back, we turned overweight on India in our within our EM strategy framework. And there are a bunch of reasons driving that view. Firstly, growth did slow down, but we believe it's a cyclical slowdown and we should see improvement going forward. We have already seen certain actions by the RBI, government, etc., which gives us more confidence on the growth outlook improvement going forward. Of course, these things do take some time to reflect. So it will take time, but the outlook seems to be improving. From a EM perspective, what we noted in our US marketing trip as well, and even our regional data seems to support it, is that EM funds in general are underweight on India. And our regional team does this analysis on a monthly basis. And EM funds that we track within that study, they are around 150 basis points underweight on India, right? And if you look at the last 20 odd years, India has mostly been an overweight. And even if it has gone to underweight, it has been very briefly a few times. So that setup also is more favorable. On valuations, we have seen the market pulling back, like it had gone to highs of Nifty 22, 23 times earnings at the peak. Now it's kind of come down to 18.5, 19 times. So that looks a lot better as well from a valuation standpoint. And then finally, from a flow perspective, we have seen a fair amount of outflows since October. But the outflows on FII side seem to be slowing down. And so far, the domestic flows have been pretty resilient. So when you kind of put everything together, there has been a valuation correction. We believe growth should see pick up as we go forward. And the setup from a positioning perspective is also favorable. So that's the reason why we are increasingly, we have turned more positive on the market. And we recently changed our stance to overweight within our EM strategy.
So Surendra, just to continue that point, you're overweight India. So if someone has to buy Indian stocks or give us the way you would construct your portfolio, what are the sectors that you like and which ones would you avoid now?
Yeah, sure. So what, like in terms of sectoral overweights and underweights, where we are overweight today, firstly is financial services, where we think that things are kind of gradually starting to improve. And again, it's a modest improvement, but it's not getting worse. And valuations in the context of the market or in the context of history are quite attractive. And again, we are more positive on the larger names in that space. That's the first pocket. Secondly, there are a couple of sectors where there is good earnings visibility, be it the telecom players or the domestic healthcare space. So those are again another space or other spaces that we like. And then we have cement, where we turned positive a couple of months back or maybe 3 months back. So there again, our view was that things should improve, should pick up from here. And last year was a weak year. So stocks had corrected. So yeah, those are some of the sectors. And then beyond that, there are some specific themes also that we like. Like, for example, travel is one space where we think the domestic travel market is quite strong. And there are plays on that which should continue to do well going forward. Overall, like IT services and consumption in general, beyond a few pockets, those are the two sectors where we still have a relatively more cautious view. So that's how we are positioned right now.
All right. Good morning, gentlemen, and good to have you all on the show. Well, Surendra, let's push a couple of those points a little ahead then. You're broadly focused on the domestic themes. Cement, as you said, the healthcare space as well as what you're looking at. Let's, focus on a couple of things that you said. One is the rotation trade, the money moving to China. And China has done a relative outperformance in the last 6 to around 8 months. Bulk of that rotation trade, is it done? And since FIs have been, underweight on emerging markets on the whole, do you think it makes a strong case for them to come back? And should we see this big outflow gradually start reversing in the months to come in 2025?
Sure. So, see, there are a few variables here to keep in mind. Like if you look at the dollar had gone from, say, DXY had gone from 100 odd levels to 108, 109 levels a month back or so. And from there, it's kind of retraced back to 103, 104. Which is usually relatively better from a EM perspective. So that's something I would watch out for. And we have seen kind of outflows kind of slow down very meaningfully in the recent past. So again, we are monitoring trends, but overall it does look that at least things are not as tough from a foreign flow perspective as they were in October, November, December. So that's something to watch out for. Secondly, on the other part of your question, China versus India, again, obviously China, if you look at MSCI China this calendar year, there is a 20% outperformance versus India. And a lot of that has to do with the Chinese technology stocks, right? If you look at the tech index there, it has outperformed the broader market there by another 10 to 15%. So it is a tech-driven rally. So when we talk to clients, I think the market, Chinese market from a valuation perspective was obviously low in the historical context. So there is interest. But I think from an India perspective, what is really required is the visibility of a growth pickup. For a lot of investors we talk to, India continues to be a secular play within the EM space. Valuations had gone higher and there was a cyclical slowdown, and that is what resulted in people taking off money from India even within the EM framework. So I think that is what really needs to be visible, the growth pickup, for people to be more interested in the Indian market.
Okay, all right. Another level that we look at, the Nifty, well, we have come down from around that 26,500 or closer to around 22,500. What's the year-end target on the Nifty itself, given that earnings should come back, CapEx spends are picking up, the RBI is injecting liquidity as well? What's the level we should be working with for the next 12 months?
Sure. So we have a published target of 26,000 on the Nifty, which is like, say, 15-16% upside from current levels.
Okay. All right. So still looking at 26,000, perhaps by the end of the calendar year. Got that, Surendra. Let me come to, Samiran for a couple of questions. We're talking about this growth slowdown. Samiran, so, where do you think we're heading next? Because now we have a turbocharged RBI. I think your own models talk of 2 rate cuts somewhere in the middle of this year, 25 basis points, 2 rate cuts. There's this big liquidity bonanza just today. This big OMO is happening. So you think that will sufficiently propel us forward to meet our targets? I don't know. A lot of people say the fourth quarter sort of asking rate is too high. We'll have to grow at 7.5% to meet the full year targets for FY25. But given the pace at which the RBI is moving now, what do you think about growth prospects for the next year?
So from a policymaker's perspective, there are 2 different tracks that they're working on. On the fiscal policy side, we have seen a personal income tax cut, which is worth about 30 basis points of GDP. And from the monetary policy side, again, there are different approaches being taken. First is that the exchange rate has been allowed to adjust back from the overvalued levels to a much more fair value level now. Second is that the liquidity easing has been very, very consistent and much stronger than what market expectations have been. Third is the rate cut process has started. And fourth is there has been some relaxation on the macroprudential regulations. Now, this package in itself could be worth about 30 odd basis point of GDP, just from the perspective that 50, 75 basis point of rate cut should bring down the borrower's borrowing cost by that much amount. So 30 basis point of GDP from the fiscal side and 30 basis point of GDP from the monetary policy side could be the immediate boost to the household's purchasing power, so to say. And then if this liquidity finally kicks in into higher credit growth with a lag, then that can be another booster to overall growth. So we think that 6.5 to 7 kind of growth for next year is quite doable. Just on a small note, the estimated fourth quarter GDP number is probably not that important a variable to look at, because the first 2 quarters data will get revised as we move into the full year number to be released in May. Once that adjustment happens, then the whole profile of the quarterly numbers could be much more stable.
So, Samiran, hearing you talk about our domestic engines, one feels very, very confident, right? Because the twin engines are firing, both fiscal and monetary. And like you said, 30 plus 30, that's 60 basis points for Phillip to GDP straight away. But now we have to superimpose the global uncertainty and this absolutely dizzying, crazy tariff business. And we don't know where the parlays end up finally between India and the US. There's still a negotiation for a trade deal, so we don't know what the final numbers will look like. But even if we go with absolute reciprocal tariffs, what's the hit that will have to be perhaps penciled in, and will local growth still more than make up for it?
This is a very complicated exercise with incomplete information, because we just don't know how the tariffs are going to be imposed on different countries, whether this is going to be sector specific or it is going to go down to the product specific levels. So what we have done is we have done a very simplistic analysis of equalizing the weighted average tariff rates of both the countries. US will probably have to then increase tariff by about 8 percentage points. And given some elasticity estimates that we have, we think that's worth about $7-8 billion of impact on India's export, everything else constant. That's about 0.2% of GDP. However, we are very much conscious that this will not be as simple as it looks like. This game could be played from India's perspective by cutting down import duties also on some of the items. There could be, in fact, we think that beyond the tariffs, what is more important is that if India starts purchasing more of US energy and defense, that's a better way to reduce the trade surplus that India has with US. So it's too early to get into a very precise assessment of what the direct impact is going to be. But what we are also worried about is the indirect impact, because this uncertainty, the longer it lasts, it will affect private investment, it will affect markets, it will affect, through a negative wealth effect, the consumer behavior as well.
But Samiran, just to complete this point, in your projection of, I think, 6.6%, right? For FY26, you're at 6.6% GDP growth. What impact, if any, of this tariff issue have you factored in to get to that number of 6.6 for next year?
So at this moment, we have put it more as a risk factor rather than putting it into our baseline. Okay. So that's 0.2% of GDP. You can think of that more as a risk.
All right. Samira, one more point on the RBI cuts. I think you're factoring in 2 more cuts, right? What if the Fed doesn't move at all? You'll have considered that as well in your model. 2 rate cuts is what we're going to get, irrespective of what happens?
So in fact, we have used a very operative phrase that at least 50 basis point of rate cuts. Our City House view on Fed rate cut is 5 rate cuts this year. So we have taken that into consideration as well. However, I must say that at this moment, the RBI, the way they're positioning itself on the growth and inflation dynamics, it looks like there is scope for rate cuts in India, regardless of what happens in the US. India's capital flows are less interest rate sensitive than growth sensitive. So if we can get our GDP growth numbers up, we'll start seeing the capital flows come back, and that will stabilize the BOP, that will stabilize the currency. We need not worry as much on the rate differential with US at this point of time, given where our macros are.
You said 5 Fed rate cuts or 5 rate cuts from RBI?
Fed rate cuts. I mean, we have a view of 5 rate cuts in US this year.
Oh, this year. Okay, got that. That'll be quite the bazooka for the markets. But Kunal Shah, Director, India Banks Financial at Citi, has also been patiently listening in. Kunal, it's all happening in the banks and it's all happening with IndusInd Bank. We know your preferred financials include HDFC Bank and ICICI Bank and Kotak Mahindra Bank and not in IndusInd Bank. But give us your thoughts on what's transpired in IndusInd Bank over the last 24 hours, what your conversation with investors are, what are they doing with IndusInd Bank? Have they just thrown in the towel now? Share your initial thoughts on the fiasco that's played out.
Yeah, so in terms of the filing, we have seen that there has been discrepancy to the extent of 2.35% of the net worth. And that will be accounted for in 4Q earnings. That's what they indicated in the call. So people are looking forward to how the earnings are going to pan out over next 1 or 2 quarters. And the other aspect is in terms of the succession plan. So now post Mr. Katpalya, who takes up, who's coming over, I think that's going to be the key monitorable as we move forward over next couple of quarters.
But is the stock looking attractive to you after this kind of a fall? And there are some worries that, things could go downhill, on Twitter, which is not the, apt space to get your opinion in. But there are comparisons of fears being drawn. Will it be similar to, say, a Yes Bank? So, what would you advise doing with IndusInd Bank shares now?
So there are near-term uncertainties. There is an overhang which is there, both with respect to the earnings as well as on the succession, as I was indicating. But in terms of the valuations, again, when we look at it, it's closer to like 0.6 times multiple. And that's where, so maybe near-term, definitely we could see some kind of an uncertainty being there in the stock. But valuations, when you look at it, that has also come off and it's factoring in those kind of a risk currently, yeah.
All right. The market cap sub 50,000 crores for a business size of more than 7.5 lakh crore. Abhishek, our banking expert, tells us that as well. So interesting to see how that pans out. But Kunal, what about for the banking, the credit growth itself? What are you factoring in? There was a bit of a scare a few months ago when it came down, I think, to around 10-11% or thereabouts. What are you factoring in for the coming year for the credit growth for the industry itself?
So we are looking at, we will see some kind of a boost to the extent of 1 or 2 percentage points in the credit growth from where it is currently. And as Samiran was indicating, now we have seen the liquidity injection. There will be some push towards the retail credit post this entire decrease in the tax rates. And in fact, RBI has also restored risk weights on a couple of business segments. So NBFC credit and when we look at it, unsecured credit was something which was driving down the credit growth over past 6-7 months. Maybe some normalization over there could also help boost it. And along with that, some pickup on the corporate credit side, which is still in the range of 6 to 7 odd %. We should see some upside as the investments kick in. So all three vectors, maybe I would say the retail credit, RBI's risk weight decrease, as well as some inch up on the corporate credit side, should help take credit growth towards 13 odd %.
Okay, Kunal, what about the big call you made in the recent past, last couple of weeks? Everyone was looking at stocks that have corrected and valuation-wise have become fairly okay. And SBI was one such name. Did a big change of stance on that one. Tell us more about that. Valuations comfortable, decent return ratios, and you have credit growth as well. That's the big call, right?
Yeah, so overall PSU banks, when we look at it, valuations have come off a bit and we will see them getting the benefit on the credit growth side as well. And credit cost, when we are looking at for the PSU banks, that has been relatively low compared to their historical past. So all that is helping them in terms of sustaining the ROAs for PSU banks.
Surendra, I want to come back to the headline point that you made on FPI selling and the fact that the positioning is at now multi-decadal low, not even multi-year low. aside of the fact that obviously this is tactical positioning, right? I mean, whether it was the home market bias, whether it was some tactical quick shifts to China, which one understands. Aside of that, is there anything else that FPIs have sort of had an issue with in India? There's been some murmur on taxation, for instance. We also hear some murmurs about how, registering in India is very time-consuming and difficult. But I don't know, maybe these murmurs also come through when a market is falling. In a rising market, you don't hear them. But what's your sense? Any other issues that are bothering FPIs?
Yeah, so I think I just add the point there that India's weightage in the EM indices has also gone up substantially. Okay, so say 5-6 years back, India's weightage used to be 8-9%, today it's 17% or so. So the weightage of India has gone up substantially, so that also kind of needs to be kept in mind. On the other points that you mentioned, again, I don't think a lot has changed in the last 3-4 months. Okay, so to that extent, I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective. Right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. If you see where the market pulled back and where FI flows happened, one of the things was the cyclical slowdown, right? But the fact is FY25 earnings have seen a moderation versus the start of the year expectation of Nifty delivering low double-digit growth will possibly end up with mid-single-digit growth. So to me, earnings moderation was one of the reasons, in addition to the stronger dollar and then later on China bouncing back. I think a lot of things came together, but the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India.
I absolutely agree with you. At the end of the day, I mean, earnings speak for themselves, and at times they can speak the loudest in the room. Speaking of which, for FY25 is over, like you're saying, it's been a disappointing year, right? Maybe we'll get 6-7% at max. FY26, what's the growth that you're penciling in? And the larger question, do you believe this market can still keep compounding earnings at, say, 12 to 15% every year?
Yeah. So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year, FY26. And again, the drivers, again, Samiran kind of spoke about the view on GDP. And we should see an improvement pretty much across quite a few sectors. So to that extent, that's what is really required. You need to see the visibility of earnings kind of getting to that number. We have been in an environment last few quarters where earnings have been revised down. So I think stability in the earnings outlook is the first thing we would watch out for. So that, I think, that number staying at low to mid-teens, I think that is what is really required for the market to find support and start going up from here. Medium term, I think low double-digit growth still possible in our view. Like if you look at nominal GDP growing at 10-11%, which is what the expectations are, then I think a growth which is somewhere in that territory. Of course, it could be volatile year to year, depending on how each of the sectors move. Particularly commodities do add a fair bit of volatility and so on. But I think that kind of a medium-term compounding is possible. And that's what really makes India attractive from a EM and investors' perspective.
And just to complete that point on financials, which is one of your biggest overweight calls, Surendran, whatever's happened with IndusInd Bank, say, yesterday, or let's talk about the last 1 year, right? There are different regulatory issues with different banks that have cropped up. With Kotak, it was onboarding, new customers on the digital platform. HDFC Bank went through its sort of, period of regulatory changes and uptick as well. Now, the problem with large banks is that even if you're overweight, even if you have them in your portfolio, they'll not perform till those FPIs return, or at least if they stop selling every day. So then how is the best way to play financials, given the rate cut view that Samiran spoke of? Because with large banks, you're stuck. I mean, you'll always be subject to the vagaries of FPI buying or selling.
So, see, I would kind of highlight a point here that within some of the, and I can't comment on specific names, but within the large banks you mentioned, there are names, or there is a name which has kind of outperformed through this period. Okay, consistency in performance is very important. And I think what we are looking at is a framework of two things. Is the outlook getting better, both from a growth perspective, a regulatory perspective? Everything put together, is the outlook getting better at the margin? And secondly, where are valuations in the context of history and in context of the market? That's the broad framework, and all of these parameters, we find the large banks attractive. And I think finally the outperformance will come from consistent business performance, because even the names that you mentioned, if you kind of just go back and look at 1 year, 2 year performance, there is a fairly big divergence, while we tend to categorize them together. So I think consistency in operating performance is what will give you the returns going forward.
Okay, all right. We here in India, we're worried about these FI outflows, which have clocked $28 billion in the last 7 or 8 months or so. The question is, where are these flows going? Samiran, I believe you've done some work on that. The flows are out of India, and all of a sudden you have the European economy that's bouncing back. China is showing signs they're coming back to life. Where do you see, where are these flows going? Leaving India, FI flows, but going where?
So in general, this is the period where we have seen some new narratives cropping up. There is a US exceptionalism narrative which has brought flows to US. There's a strong dollar narrative which was going on that has taken money out of EM. Now in Europe, there is a narrative of European defense spending and infrastructure spending probably adding more than 1 percentage points of GDP every year for the next 5 years. That's probably dragging money into Europe. Whereas some other parts of the world, like Japan, like in India, we have seen outflows happening because the narrative, there's not been a new narrative. It's not that there's been anything in particular negative about India, but it's just that there have been more attractive narratives elsewhere. Surendra was talking about the China tech being another narrative, which has also drawn interest from investors. I think this is markets. The markets will work on narratives, and at some point of time, different economies will be able to provide those narratives. We just hope that in the Indian context, the growth narrative comes back in FY26, given our expectations of the policy support that has already taken place.
Samiran, finally, since you mentioned Europe, I just want to ask you this, because this is a new game in town, right? First, it was US exceptionalism and the numbers were supporting it. Then there was a lot of the talk of Chinese stimulus, and then you had a tactical China trade. But Europe, like I said, is literally the new game in town. I mean, the amount of money that's pouring into European equities now. And we're seeing what's happening with German bond yields as well, with this whole so-called rearmament exercise. Do you think this is meaningful from near to medium-term point of view? Or is this just the market getting excited because we've not seen anything out of Europe in so long?
Yes, at this point of time, it's all about announcements. The next in line would be about trying to find the funding for this. At this moment, most of the funding is coming out of the national budgets rather than any specific fund at a European level for it. So we'll have to see which country has how much space in their budget to do these things. We are already seeing that countries which are closer to Russia are announcing a much larger defense plan compared to the rest of the countries. So that's the second part, which is the funding part. And then the third part would be the execution part on exactly how this money is going to be spent. If Europe just ends up buying or importing these armaments from somewhere else in the world, then it does not add up to the European GDP as much. But if this leads to more production within Europe, then the growth outlook becomes stronger. Our European economists, they think that the near-term growth impact for 2025 or 26 is relatively low, in the range of about 0.2 percentage point of GDP only. But if you move to 2027-28, then the impact could be more meaningful at 0.5 to 0.9% of GDP. In the context of Europe, which anyway grows only about 2% or so, this could be a very meaningful push up in GDP growth if it actually happens.
That's very, very interesting. That's helpful perspective as well. I mean, really explains why the equity bulls are suddenly rushing and piling into European equities on that hope of that GDP boost coming through. But we hope, of course, that India continues its charting its own growth story as well. Gentlemen, thank you very much. It's been a pleasure having you on the show this morning. Thank you for all the perspective. Well, there you have it. That's the view coming in from the Citi India top team. We have to take a quick break right now. On the other side, we get chatting with Sunil Bora of Uno Minda, talk about the company's business outlook in the face of a lot of tariff uncertainty.
Or 2 downgrades on Infosys, and that's putting pressure on the stock. Morgan Stanley too prefers TCS over Infosys. So keep your eye on the tech developments. But let's focus on Tata Motors. That's up more than 2%. Sudarshan joins in.
So Tata Motors is today top Nifty gainer. It's up around 3%. Remember, the stock has been amongst top underperformers if you check the graph of the recent past. And stock was around 52-week lows. It's down 12% in the last 2 to 3 months, basically in 2025. Now, today it's higher because Tata Motors CFO had held analyst meet yesterday, and the commentary that's coming out of that analyst meet is looking largely positive. So first on JLR, company has maintained Q4 EBIT margin guidance of 10%, and the second guidance that has been maintained is to be net debt EBITDA positive by FY25 end. Now talking about geographies, company says that US continues to do well. In China, it's outperforming the industry. In EU, demand is less challenging than what company had expected, and even UK is improving. On domestic front, it says CV margin has been performing as per expectations. One segment that needs an improvement is passenger vehicle segment. And going forward, company's focus would be arrest market share loss, especially in the small CV segment. Now, following that, most of the brokerages have come out with a note, and most of them are largely positive on the stock. Nomura has a buy call, target is 861. Macquarie has an outperform call and target is 826. CLSA has high conviction outperform call and target is 930. GS has neutral call with a target of 690, and Nuvama maintains reduced call and target is 720. So overall, it's looking positive for Tata Motors, at least the commentary that has come out from the analyst meet.
Okay, all right, sir. And, the big positive from an India market perspective as well as economy perspective is the decline we've seen in crude oil prices. That's what's caused OMCs to spike up. Today as well, they're surging. Tell us more.
So if you would have seen in the last few sessions, all these OMCs have been gaining except 1 or 2 sessions. In the last 5 sessions, these 3 stocks have gained somewhere in the range of 10 to 15%. Today, these 3 stocks are higher because Avendus has come out with a note, and it has upgraded both HPCL and IOC and has maintained buy call on BPCL. For HPCL, target is 460. For IOC, target is 155. And for BPCL, target is 400. So it has given 3 reasons. First, benign valuation. It says valuation is 15 to 25% lower against 10-year average price to book value. Second, crude prices. You would have seen that in the last few days, crude has seen a sharp fall. Brent has come below $70 per barrel, and that's the reason even Avendus is expecting Brent to remain below $75 per barrel. And third is stronger GRM that Avendus is expecting. It's saying that slowdown in refinery additions in CY 25 and 26 points to a revival in GRM, and that would be positive for OMCs. Second, expansion in auto fuel marketing margin and reduction in LPG losses will be a key play in FY26. And last is, it sees high chances of H1 FY26 profitability for all the 3 oil marketing companies to be more than 70% of FY26 estimates that it had earlier. So on the back of this, you are seeing a big move in all 3 names today.
Thank you very much for that. Moving on now to the auto sector. Domestic auto industry has seen muted growth in the second half of the year. And the question is, will Trump's tariff war impact autos, especially companies with exposure to the European region also? To discuss all this and more, Sunil Bora, Group CFO at Uno Minda, is now with us on the show. Mr. Bora, that's the first question, right? How do tariffs impact you? If you do get any sort of reciprocal tariffs, if you could lay out how you're assessing the impact for you, considering your export exposure, and also European markets were downbeat for you. You've highlighted that in the past. What are we seeing right now? in the Jan to March quarter? Have things improved? And what can you guide for FY26?
Yeah, so thanks. In terms of your first question of tariff, so if you see our total revenues, we are largely a domestic company. Almost 89% of our revenues are domestic driven, and roughly around 18% is what we get from our global revenues, which includes operations in ASEAN, in Europe, and we have small plant in Mexico. So overall, if you see of the overall pie, the exports from India is roughly around 4%, 3 to 4% of our total revenue. So as of now, we don't see any significant impact based on whatever discussions we are having with our customers. The exports, whatever we are doing from India for some switches or seats, we are not seeing any material impact as of now, but definitely things are evolving as we speak on a daily basis. So we are keeping a close watch on that. So as of now, we don't foresee any significant impact in the short term. In terms of your second question, which is Europe, in terms of our revenues, definitely things have been sort of stable to, I would say, marginally positive, because the revenues what we have generated from Europe in January and current February, whatever the trends are, they looks to be stabilizing in terms of volumes, and even our revenue is marginally better versus if I compare with the December revenue. So things are stable, but I would still be very little cautious, and we are not very too much optimistic in the short term in Europe, while things are stabilizing and looking little positive.
Okay, let's focus on the bigger part of your business then, Mr. Bora. Europe is still to come back to life, but you have 89% of your revenues from the India operations. Has there been any kind of slowdown? Is demand, ordering activity as good as what you expected in Q4? And what does this mean for the next couple of years? That's FY25, FY26 as well, on the base that you deliver on FY25.
So we have no reasons to complain in terms of volumes. Things are definitely, we are in a business, and business will have ups and downs, but overall things are positive. In fact, if you see full year two-wheeler revenues, two-wheeler volumes are roughly around 9% higher. PV is roughly around 5%. In fact, last month is almost like closer to double digits in terms of volumes. And in terms of the medium term to long term, you spoke about 2 years and beyond. So we are very, very optimistic. And as you know, that we are currently having 12 projects or 12 plants under construction. And we have been building some of the lands for our future growth. So we are very, very optimistic in terms of the industry growth. We are roughly at 4.5-5 million PV cars this year. Hopefully, we should grow 2x in next 7-10 years. We are way, way below some of the global benchmarks in terms of vehicle ownership. So we are very optimistic in terms of 2 to 5 year kind of a scenario. Yes, there are some ups and downs, as I said, because of being in business. And as we always say, we continue to maintain our guidance in terms of our performance. So while we don't comment on volumes, whatever industry grows, our goal is clear that we grow at least 1.5 times of industry growth. So if industry in next 5, 7, 10 years grows 2x, we have to see how do we grow 3x in terms of our revenue. So that's where we are, and we are quite optimistic, and we continue to invest in our expansion plans.
Okay, all right. Could you tell us about the EV focus of the business? You know, how much does it contribute? Because that's been growing at a very, very fast clip. And that's definitely going to help you in terms of a kit value as well. So how do you see it panning out from here on?
No, absolutely. So we have been front runners in terms of EV capturing the business for specifically two-wheeler and three-wheeler sector. And if you see the two-wheeler sector, we are almost 2x of the industry penetration in terms of revenue. So industry growth is somewhere around, industry penetration for EV in two-wheelers is somewhere around 6-7%. Whereas of our two-wheeler, the revenue pie is roughly around 13%. So we are almost running at 2x of the industry growth. And that's clearly demonstrating our ability to capture the EV market share. In terms of our kit value, as you rightly mentioned, while the ICE kit value is roughly around 10,000 rupees, our EV kit value is almost 35,000 rupees per vehicle. And that market is still in a developing stage in terms of what gets to outsource, what get in-house, etc. So we've been working very, very aggressively in that space. In fact, moving to the PV space, as you would have noticed, we have been front runner again in localizing, working to localizing some of the EV components for pass cars. And we have recently converted our TLA to a joint venture with Innovance. And currently, we are in the phase of preparing our detailed project reports. And hopefully, we should be coming out with the detailed project investment plan, etc. And once we do that, then it will take roughly around 2 years to localize. And as we know that the volumes for four-wheeler are also low. So we are trying to time with the industry penetration as the volumes increase. our capex also is expected to align with that, and hopefully we should get advantage of the better volumes.
So 2 years before the localization efforts come into fruition. So how should investors look at your margins? You've guided for 11% margins for FY25. Do you think for FY26 it should be similar to 11%? When can margin expansion truly begin for you? How are you thinking about margins and raw materials cost?
So you have to see in two aspects. First, from the margins of RM cost you mentioned. So raw material for us is largely passed through, whether it's up cycle or down cycle. It's all passed through to our customers. We don't tend to benefit or we don't tend to lose on the commodity prices, right? But in terms of your question was on margins in terms of 11% plus minus. So next year we are currently working to see how do we maintain this margin. Specifically, we know that we have 12 projects under construction. As these projects come on stream, you have all the costs coming in. So you have to absorb those costs, whereas the revenue takes maybe 1 or 2 years, 3 years to stabilize and to deliver the target returns. So despite that, we are working to see how do we make sure that we absorb all those costs and still maintain our margin guidance of 11% plus minus 50 basis points.
Mr. Bora, thank you very much for joining in. By the way, the Nifty Bank, that's up close to about 300 odd points, and IndusInd Bank, that's managed quite a steep recovery. It's up close to about 5.5%. From the day's low, it's a 14.5% up move on IndusInd Bank. The Citi's banking analyst, Kunal Shah, was telling us that IndusInd was at 0.6 price to book. So at least from a valuation point of view, it had dropped to significant levels. But other banks, Kotak Mahindra Bank, HDFC Bank, Kotak Bank is up nearly 2%. HDFC Bank has moved up more than 1%. So banks are providing support, and Reliance Industries is in the green.
Okay, all right. So that's the market, at least for the time being. But yeah, the color has slipped. We've not been able to hold on to all that green. Let's go back to Mitesh now for some trading advice and calls. Mitesh, so looking at the volatility early in the morning, what would the course be now?
It's been volatile, but I think, not giving you a clean directional bias. I think just stay put on the index. As I said, I think, buy it if you get it closer to about 22, 300, 350 zone, otherwise avoid. And on the stock side, though, we have some buy calls purely because of the fact that a lot of the stocks are, kind of reversing from lower and oversold levels. So Crompton is one name on the list. That's a buy with a stop at about 346 for targets of 365. And a disclaimer, we have recommended Adani ports to our clients, so there's some vested interest over there. But that's a buy with a stop at 1126 for a target of around 1200.
Okay, all right, got it, Mitesh. Thanks very much for that. With that, we have to slip into a very quick break, come back on the other side, and Manisha will round up the latest from the commodity markets. Welcome back. Well, let's find out what's the latest in the world of commodities, given all of this tariff talk. Manisha is here. Manisha, so what's captivating your imagination now?
Well, my imagination, well, it's somebody else's imagination.
Apart from Donald Trump, what is it that you were able to pinpoint in commodities? Because everything is topsy-turvy, right?
Well, if you look at the global markets right now, all impacts really seem to be coming in from there. But I want to talk about metals right now, and that is because the US dollar index is now trading at a 4-month lows, and that clearly has been supportive for many of these dollar-denominated commodities. And apart from that, it is the chaotic implementation of tariffs that has led to a lot of uncertainty. So from standing now, what we understand is that there is 25% of tariffs on steel and aluminum that goes into effect today. What we also understand is that the 50% tariff on steel and aluminum on Canada does not go into effect today. This is as of now, right now. But apart from that, it also is about the fact that the US and Canada will be holding negotiations over the next 2 or 3 days. So this week, in that sense, is going to be quite important. I want to talk about copper because overnight, we've seen 2.5% of gains in copper. And in Asia right right now, we are trading 1% on the higher side. With that, copper is trading very close to its 9-month highs. There also are expectations of a China stimulus hopes, and that has been supportive. And then there also are concerns that China could be, or rather US could be, imposing tariffs on copper going forward. That has been a conversation for 3 weeks now, and the markets are waiting that report. That could be still 10 days away, but that is keeping the street jittery for sure. And then it is also about the kind of premium that copper is commanding in the US markets there. Not just that, when you look at the aluminum and 25% tariffs coming in today, the US physical price premium has hit a record high of $990 a ton. So aluminum is more expensive now in US than anywhere in the world. The street is also looking at the premium prices, which have continued to gain and have gained up by 70% since the start of 2025. Well, Canadian smelters really are the major source of primary and alloyed aluminum exports to US. So 70% of all aluminum alloys that goes out of Canada lands up in US. So that's a big chunk that the markets will be looking at that could be getting disrupted in sense of prices there. Apart from that, it also is about China, where we are looking at a slowdown in production for this year. Last year was a record aluminum production in China at 44 million tons, and China perhaps could be looking to curb that. Well, but apart from that, it is also about the US inflation data that comes in today, and that is going to be a major number ahead of the US Fed meeting, which is on 18th and 19th of March.
All right. Okay, Manisha, thank you very much. We will keep that in mind. We have to take a very quick break. On the other side, our special segment, It's the Economy. Lata today will speak with the head of Credit Bureau, Sybil, on NPAs in retail loans.